Hi folks, and welcome to this video on fair value through OCI investments. In this question, we're going to practice financial statement presentation for the fair value through OCI investments. So let's begin. In our question, we are asked in the first part to prepare the company's statement of financial position for the long-term portion of the fair value through OCI investment portfolio, at the end of the year. So the first thing we need to do is we need to determine two things. What was the cost of the investments that are currently in the portfolio at the end of the current year, and what is their fair value? Because the difference between the cost and the fair value in the year that we first bought the investments is going to be the unrealized or holding gain or loss, but that's also going to be the same as AOCI, or accumulated other comprehensive income. Remember, we talked about this concept earlier. We said that whenever you wanted to calculate the AOCI balance in the shareholders' equity section of your statement of financial position or balance sheet, what you needed to do was to look at the original cost of all of the investments that you currently have to value in that portfolio, and take the difference between that original cost and the fair value of the investments at the date you're doing the statement of financial position. It just so happens that they gave us the value of the shares that we had, at the end of the current year, and they gave us the cost. But they gave us the cost on a per share basis. So what I did here is just show you how I calculated the cost of the portfolio. I took the 2,000 shares of Frank that we had and multiplied it by $11 a share, which was the cost. I did the same thing here for the Ellis shares. I multiplied the number of Ellis shares that we had in the portfolio and multiplied it by the cost per share, what we paid, and that gave me $1.15. So I did that for all three share types. To get the fair value, all I did was multiply those same 2,000 shares of Frank, in this first instance, by the fair value or the market value at the end of the current year, which in this case was $16 a share. So they gave you all that information in the question. And I did likewise for Ellis and Mendota. So that gave us all of these fair values. So if we're evaluating as a portfolio, we can see that the cost was $261,000, but the fair value is less. It's $223,000. So on a row by row basis or share by share basis, I'm going to calculate the holding or unrealized gain or loss for the year. And in this case, when we add it up, we get an unrealized or holding gain or loss. In fact, in this case, it's a loss of $38,000. So what's the first thing I'm going to do? Before I do my statement of financial position, I am going to reduce the fair value through OCI investment to $38,000, or by $38,000. So I'm going to debit my unrealized or holding gain or loss in OCI, and again, because it's a loss, which I have here, it's a debit, $38,000, and I'm going to credit the fair value through OCI investments in the fair value through OCI investment portfolio. So I take it as a portfolio, $38,000. Now, again, when we go to do the statement of financial position, what do we see? We're taking the investments at fair value, putting that value in our long-term investment section for our fair value through OCI investments, and in the shareholders equity section, remember what we discussed? We said the difference between the original cost, which they gave us enough information to calculate, and the fair value of the investment portfolio that you're valuing at the end of the year, the difference between those two is going to be your AOCI. And that gives us again an AOCI debit of $38,000. Now, they asked us also to do the statements for 2015. Now, in the original solution to the problem, because they only asked you to do the statements, they didn't do any of the entries that I'm going to do here at this point with you, so that you can make the entries that are required because we sold the Frank shares. So in this case, we notice that throughout in 2015, we sold all of those 2,000 Frank shares. So what we've discussed is that when you sell a fair value through OCI investment, there's three things you've got to do. Number one, you have to bring the fair value of the investment portfolio, or the carrying value of that investment in your portfolio. You have to bring it to its fair value at the date of sale. The second thing you need to do is you need to sell the investment. That brings that fair value through OCI investment that's in your portfolio to zero. Because you no longer have that investment, any cumulative unrealized or holding gains and losses on that investment must also be reclassified or recycled. In this case, we're recycling it through to retained earnings. So that's your third step. And again, as we've said, if you no longer have the investment, like you got rid of it in step 2, there's no sense in keeping any unrealized gains and losses on that same investment. You have to clear those off. So they have to go somewhere. So we're going to recycle or reclassify them into retained earnings. So the first thing we're going to do in our first step is we are going to set the Frank shares that we're selling to their fair value. In this case, we're selling all the Frank shares, and they also told us that there were transaction costs here. There was a 1% commission. We're selling them, okay, for a 1% commission, but the fair value at the date that we're selling them, they gave us in the question, that fair value was $17 per share. That's the value per share at the date that we're selling the investments. So now, that's $34,000 that we'd get for the shares, less 1% of that $34,000. So that's going to give us $33,660 as the fair value. Some students might do it as $34,000 times 0.99 because you realize that's 100% of the investment minus 1%. That would give you 99%. So you would be setting the investment to its fair value net of the commission. So some students might opt to do it this way. It's up to you. The carrying value of the investment at the sale date is exactly what we last valued it at. At the end of the previous year, we had set the fair value through this adjustment to $32,000. So if we compare that, we can see that now we have an unrealized gain on the investment at the date we're going to sell it of $1,660. So now what we're going to do is we're going to make the adjustment in our step 1 entry to set the fair value through OCI investment for the Frank shares, that portfolio. We're going to increase it by $1,660 and then credit an unrealized gain or loss into OCI because of the revaluation of those Frank shares to $33,660. We're going to credit that account $1,660. Now don't forget, after we make this step 1 entry, those Frank shares are now sitting on our books at $33,660. So when we sell them, we're going to get at net $33,660. And then that means we're going to get that amount in cash. And again, that's net of the commission. And we're going to credit the fair value through OCI investment, which means we're getting rid of it for $33,660. So we no longer have those Frank shares sitting in our portfolio. All right, so now what's the last thing we need to do in this 3-step process? The third step is to say, well, if I no longer have the Frank shares, what is the total cumulative unrealized or holding gain or loss that I've been booking on those shares? Because if I no longer have the shares, I don't need the unrealized or cumulative unrealized holding gains or losses. So let's go figure that out. Well, don't forget, you said at the end of the first year, you had a holding or unrealized gain of $10,000 for those shares. You also booked into OCI in step 1, $1,660 on those shares. So in total, you have an unrealized or cumulative unrealized gain or loss, and in fact, it's a cumulative unrealized gain of $11,660. So we're going to remove that unrealized gain or loss credit to OCI. So to remove it or to zero it out, we debit it. That sets it to 0, and we reclassify it into retained earnings. So it's $11,660. So the question didn't ask you to do the entries, but I like to do them with you because it is going to make a difference in what you present in your statements, which is what we have to do next. So the next part of the question said, now that you know all of the investments that are left at the end of 2015 or 2014, the end of the current year. Now what we need to do is we need to go in and revalue the portfolio. Notice here that we no longer have any of the Frank shares. We've got the original Ellis shares that we started with and the Mendota shares. And what we did is we took their cost. Their carrying amount here that we have is based on the carrying amount that we calculated at the end of the previous year. And if we go back up here, we're going to see it's 95,000 and 96,000 respectively. But don't forget, during the year, you also bought some new shares, Captain shares, and you paid 50,000 for them, and and you didn't revalue them since you bought them, so they're being carried on your books at 50,000, but their fair value now is 44,000. So now we compare the carrying amount on our books. So we're looking at these two columns here. We're going to compare the carrying value, which was our value that we had for the Ellis and Mendota at the end of the previous year, but for the Captain, their carrying amount is what we paid for them. Right? And take the difference between the carrying amount and the fair value at the end of the current year. And that's going to give us a holding or unrealized gain or loss for each security as follows in this column. So in total, we see for the entire portfolio, we're going to have an unrealized or holding gain of 35,000. So I'm going to make the journal entry to debit the fair value through OCI investment, bring it up for 35,000, and credit the unrealized gain or loss. So that's a credit to this OCI account for $35,000. Okay, so now the reason I included the cost column, we've talked about this before, that the difference between the cost and the fair value at the end of the current year is going to give me the balance in AOCI. So if I look at the difference, I can see that my balance in AOCI is now going to be negative, or a debit balance of 13,000, the difference between 289 and 276. I'm also going to have in my long-term investment section in the asset part, I'm going to have my investments at fair value with gains or losses going through OCI, or you could call this fair value through OCI investments, and that's going to be at the fair value of 276. All right. Now, if I'm doing my statement of comprehensive income, now I have to do a little bit of work here. They gave me $158,300 as my net income. But in my statement of comprehensive income, I also have to add in my other comprehensive income. Okay, so now what have I got there? I've got items. Okay, I'm just going to remove that so it doesn't confuse you. I booked into OCI this year, because again, I'm only in 2015. I booked into OCI $36,660. Now, where did I get that? Well, we know that here we booked in this year 35,000 in there, right? And we also booked in step 1, right? In step 1, we also booked 1660 into OCI. So in total, that tells me that I booked 36,660 into OCI. So I'll just do that calculation for you here. Oops. Plus 1660, right? Just in case you want to see that. I'm going to try and make this a little bit smaller so it doesn't fall off the page. So it all lines up a little better. There you go. So now you can see how I got that. So I'm only looking to what we've booked in 2015. But now, regardless of when I've booked the unrealized gains or losses that I'm transferring to retained earnings, that doesn't matter when I booked them. But in the year that I sell those investments, and that's related to the Frank shares, now I have to remove or deduct. In this case, we said we had unrealized gains accumulating on the Frank shares of $11,660. And again, don't forget how we got that. We said we had $10,000 from the previous year and $1,660 from step 1 in this current year. And that gave us in total cumulative unrealized gain credit of $11,660. So regardless of the fact that this was something that was booked in the previous year, it doesn't matter. I still have to recycle it or reclassify it into retained earnings in the year that I sold the investment. So I'm going to deduct the gain, which is positive, right? I'm going to deduct So bracket, again, which is plus or credit, 11,660. So that's going to give me 25,000. So that gives me comprehensive income of 183,300. Now, the other thing you could do in order to calculate this AOCI balance, because some students would do the statement of comprehensive income first. If you did this, right, this is the amount that's actually going to AOCI this year, right? So we know that's the amount that goes to AOCI. You know that originally you had, in here, you had negative or debit 38,000. So what some students would do is they would say, well, if I already have a debit balance of 38,000 in the AOCI, and now I know that what I calculated for the next year is going to also update AOCI, some students might say, well, instead of doing this calculation here, which by the way I think is easier, but you don't have to do it. Some students would say that AOCI would be their negative 38,000 that they calculated in the previous year, plus their 25,000 that they booked right now in 2015. So they could take this amount and add it to the amount that's already in there at the end of the previous year, which is debit 38,000, right? And they would get here a debit balance of 13,000. So that's another way that you can come up with this number. All right. So this concludes our work on this problem in preparing financial statement, in preparing partial financial statements, and showing you how we calculate the amounts that go on them. So I hope you find the video helpful.